But many of the title lenders are reporting and allowing people to
Right, and that's on the CFL side.
as would be most in the pilot program.
Pilot program, yeah. And those 2,500 and below.
Okay.
So most of your CFLs do. They do.
Okay. Grab.
Thank you very much, Mr. Chair. Commissioner, thanks for your testimony. Could you, as I think about this, I've been a financial advisor for 20 years, and I'm not involved on the debt side, but I'm sensitive to these issues. So it seems to me that because all we have right now is the pilot program from the level of $300 to $2,500, but the online space, the unregulated online space, is potentially very large in this marketplace. Can you talk about what your best estimate of the total size of that marketplace might be, and also the practices that we are seeing in that marketplace?
I'd love to talk about that. In all candor, we don't, and I'm looking to see if I have. We really don't have any good information, but I will tell you, so unlicensed online lenders, we have developed a partnership with the search engines. So if we have a regulatory order against an online unlicensed lender, we send that order to Bing, Yahoo, Google, and they will take down any of the advertising for any of those lenders, and they'll take, if they're advertising on their search engine, they'll bring them out. I wish I could tell you there were some numbers. I don't have any, but I'll go check to see if anybody's talking about any numbers, but we sure don't have any.
Got it. And the reason I ask is maybe just your personal thoughts, if you could digress from the official talking points for a moment. And I know it might be a lot to ask, but this is a space that is very useful to a lot of Californians. And, you know, there is the pilot program, but the total volume of loans being made through that pilot program, I think we would all agree are less by a vast number than the loans that are being made in total in that space. What are your personal thoughts about, you know, obviously the CFPB is looking at regulations, and we are, the purpose of this committee is to take a look at where California might be. What are your personal thoughts in terms of what that marketplace might ultimately look like, and also the need for California regulation in that space so we can actually offer a viable product?
Thank you, Mr. Vice Chair. I'm a regulator. The vision for the mission for the department is that you provide a strong financial services products, individuals, and services for all Californians. So a product that might be very good for you might not be so good for Assemblymember Hadley. Mm-hmm. And we have to have the ability to offer a safe product for all consumers. So I like to see lots of licensees, or come on in, you know, the water's fine, so to speak. How that works, and to try and get more participation, is one of the reasons we're here, is to try and get more regulated products, services, companies that will provide a safe financial system for all Californians and consumers, and I feel very strongly about that. How that looks is why we're here. I believe in a strong regulatory environment with the ability, as you said, for innovation. And it's a sweet spot or a fine line of where to go, and that's why we're here to try and do that.
We're going to go to Mr. Gatto, but right before we do that, just to be clear, we're dealing with two separate laws here. We're dealing with the California Deferred Deposit Transaction Law, which regulates what we consider payday loans. And then we're also dealing with the California Finance Lenders Law, which regulates loans over $2,500 below.
And under.
And under. And within that, we also have a pilot program that's currently in operation that sets a cap in trade-off for things like reporting and underwriting. So just to be clear, we have three things going on. Now to Mr. Gatto.
So thank you for being here. You know, I was really struck by one of your comments, which was you said something along the lines that we need to ask the providers to provide empirical data on one facet, and the advocates on the other side to provide empirical data on some of their claims. And I'm actually going to ask these questions to you, though, because I think you might provide a more candid reply. So I guess the first one is, do you have any data on the default rate for any of these different types of loans that are in your handout?
We do.
So what's the approximate default rate, ballpark?
And I will have to get back to you on that.
You can't even
because
ballpark it?
I can't even. Did you? So, Assembly Member, all the data I gave you here.
Right.
There's so much more data that we get from 20 plus companies that I'll break that out for you. You'll have it by the end of the week.
Okay. All right.
I
That's
promise.
fine. Thank you.
Thank you.
Thanks.
I have a feeling we'll have future speakers today that will bring that up. So.
I don't trust him.
Mr. Hadley.
Thank you, Mr. Chairman, and thank you, Commissioner, for being here today. If I understand correctly, all the data that you've provided is around various non-bank lenders.
All non-bank lenders, yeah. Non-depository.
Right. And, you know, at one point, not too far in the past, in the United States and in California, banks were a meaningful source of unsecured credit to, lots of different kinds of consumers. Do you have any data on their market share or their volume in terms of providing different forms of unsecured credit and secured credit in these dollar volumes?
I'll be more than glad to get that for you. I do have some. And what's interesting is there's also, and we also have consumer lending. And I'm going to throw out a number for my banks, but remember, my banks aren't the big national banks. Mm-hmm. Of about 5%, 0.5% of their portfolios are consumer loans as a total. That being said, I'll break that out for you. We're also looking at, because we've done the marketplace lending survey, we're looking at small business lending as well, and I'll get you some numbers on that.
Okay, thank you.
Okay, thank you. God, I gave all these numbers, and you guys are still asking me for more. I can't decide if that's a good thing or a bad thing.
Commissioner, thank you for your testimony
Thank you.
today. We really appreciate it. I know you will be a very helpful partner as we move forward. We look forward to your continued support of this process. And with that, we will dismiss you today, and thank you.
I'm going to stay for about another hour, and then I'll leave.
Thank you.
Thank you.
We would now like to call up from the Attorney General's office, Amos Hartson. He's the Deputy Attorney General for California Department of Justice. He will be reading a statement from Attorney General Kamala Harris, who wanted to be here today, but because of a scheduling conflict could not. We appreciate you being here today, Mr. Hartson.
Thank you. Chair and members, good afternoon. As mentioned, my name is Amos Hartston. I'm a Deputy Attorney General with the California Department of Justice, and I do have a prepared statement, and we'll also be happy to answer questions. Thank you for inviting the Attorney General's office to testify on the important issues around payday and other small dollar lending in California consumers. In particular, I'm here to discuss Attorney General Harris's concern about high-cost payday and small dollar loans and her support for the Consumer Financial Protection Bureau's proposals to strengthen protections against certain small dollar lending practices, which would complement California law. As Attorney General Harris stated in her letter to the CFPB, together with California's existing lending laws, the CFPB's proposals would bring needed protections to vulnerable California consumers who take out small dollar loans, which too often are predatory, and create a debt trap for fixed and low-income borrowers. Californians who need short-term emergency access to cash are getting stuck in a destructive and unaffordable cycle of repeat high-interest loans that they cannot afford to repay. Payday loans are prevalent in California. According to the Department of Business Oversight in 2014, these loans had an average annual percentage rate of 361%. And payday loans are not just used for short-term emergency access to cash. A cycle of reborrowing is very common. The average number of payday loans per individual consumer in 2014 was 6.82, and loans for amounts above $2,500, as we've heard, have no interest rate limits. Many borrowers are getting stuck in a cycle of unaffordable debt with triple-digit interest rates. California already provides some protections for consumers who take out payday loans. For example, there are fee caps, required disclosures, and other restrictions. California has important protections, including graduated interest rate caps for loans up to $2,500. These existing protections are important and would not be displaced by the CFPB's proposed rules. In addition, with this committee's leadership, the pilot program for increased access to responsible small dollar loans is seeking to create a competitive market for more affordable loans between $300 and $2,500. Even with existing protections, many California consumers are taking out unaffordable loans and are forced to choose between default and repeat borrowing. The CFPB's proposals would complement California's existing small dollar lending laws and programs and would bring needed reforms and additional protections to California consumers who take out small dollar loans, which too often are predatory. At bottom, additional consumer protections in this area are needed. Protections that prevent short-term credit from turning into long-term debt, protections that help reduce cycles of repeat, high-cost, unaffordable borrowing at triple-digit interest rates. The Attorney General supports the CFPB proposals, which would better protect consumers by implementing screening requirements and structural protections. One of the main proposals is the ability to repay standard. The Attorney General supports the CFPB's proposed ability to repay standard, which would require lenders to make a determination that the consumer has the ability to repay the loan without reborrowing or defaulting. This would directly help reduce the common cycle of repeat unaffordable loans. In connection with the ability to pay analysis, the Attorney General also supports the proposal to include a rebuttable presumption against repeat borrowing within 60 days of a covered short-term loan, unless there is evidence of a change in circumstances, and mandatory 60-day cooling-off period after 3 short-term loans in a sequence. Again, this provision, too, would help reduce cycles of debt. The CFPB is also considering providing lenders with the option to provide certain small dollar loans without an ability to pay analysis. In the event alternative loans become part of the proposed rules, the Attorney General supports the proposed screening requirements and structural protections and supports the proposal of an off-ramp, creating a pathway out of debt for short-term loans. The proposed protections would limit consumers to 3 such alternative loans in a sequence and limit the amount of each loan to $500. The off-ramp proposal would allow consumers to repay their loan over additional installments without reborrowing, which would directly help reduce the common cycle of repeat unaffordable loans. The proposals also cover longer-term loans more than 45 days in duration with an all-in APR in excess of 36%, where the lender holds either access to repayment through the consumer's account or paycheck or a security interest in the consumer's vehicle.
About 30 seconds.
Okay. The Attorney General supports minimum standards for responsible lending across a spectrum of small dollar loans. The Attorney General also strongly supports the proposals for curbing harmful collection practices and has also made some specific recommendations about focusing on consumer privacy because there is a proposal to include a database that contains borrowing history across lenders. The Attorney General also encourages the CFPB to clarify that the CFP does not intend to preempt or undermine state efforts to regulate in this area, and instead to encourage discussion and debate about additional regulation needed to promote responsible lending. Again, the primary reason I'm here today and the reason the Attorney General supports the CFPB's proposals is that additional consumer protections in this area are needed.
Thank you, Deputy Attorney General Hartson, for your comments today. We look forward to working with the Attorney General as we move forward. We'll now move to our next panel, Perspectives on the CFPB. And we'd ask Dennis Shaw, CEO of Community Financial Services Association, and Paul Leonard, California Director for Centers of Responsible Lending, to please come to the podium.
Mr. Chairman.
Yes.
While he's on his way up, I'd just like to ask the question, if in fact the person needs to take out 2 or 3 loans and they can't pay them back, how do the proposals to cut them off, how does that play into everything?
I think our next 2 guests will have very strong opinions on that. I agree that's a major component of what we're struggling with. Okay. Obviously, we don't have a database in the state. We have none of these financial institutions will offer multiple loans at one time, but unfortunately, I think people out of desperation seek out multiple loans on their own. So, but we'll turn it over first to Mr. Shaw and then Mr. Leonard.
Good afternoon. I am Dennis Shaw. I am the CEO of the Community Financial Services Association of America. I am, I regret to say, suffering from a very bad cold, and when I flew out here, my ears did not pop back, so I'm having a relatively hard time hearing. This is a great advantage at most hearings I go to, but it wouldn't be an advantage here. So I wanted to forewarn you of that. I wanted to tell you our perspective on where the CFPB is, and I also wanted to give you some background on what we feel would be appropriate regulation. First of all, I have spent my life in public affairs, and I know how difficult it is to come up with policies that satisfy both consumers and those who provide for the consumers, and also to place the regulatory framework in such a position that it does generally good as opposed to harm. My objections to what the CFPB has done really fall into two categories. The first is the category of process, which as a lawyer is generally fundamental to the question of how things turn out in the end. I was really caught up in your conversation about online lending because I am very familiar, since the New York State Attorney General more than a year and a half ago made a comment that suggested that payday loans were not a problem in New York State except from Indian tribes. In analyzing the facts in that, we found out that more than 1,300,000 New Yorkers had gone online in 2013 to get payday loans. If you care for a resume of where things are now, in the state of North Carolina in 2015, 425,000 people went online to get a payday loan. In Pennsylvania, 430,000. In Maryland, 306,000. In Arizona, 308,000. In D.C., 40,000. The importance of this cannot be overstated. I am aware of the anecdotes that are often made against payday lending, and some of them, of course, have validity. In my experience, the great majority of those stem from offshore, unregulated payday lenders. Not all, but certainly the most of them do. Not only is that a problem, but it is a problem that relates directly to the jurisdiction of CFPB. In one of the initial meetings we held with CFPB as they undertook the question of how to regulate payday lending, we suggested to them that their first step ought to be to get at the illegal payday lenders who were preying on people from offshore vantage points. We suggested to them that the way to do this would be to make a general rule and then to ask each state to make illegal the collection of a payday loan that was not registered. If a payday loan is not collectible, the probability is not that it is not going to be made. So we've proceeded without any success with them, nor, interestingly enough, without any promise that they would get to it. I think this is damaging both to the consumers and also to the operators who do proceed in good faith. And I think it indicates an attitude on CFPB's part that they will not necessarily respond to the area of greatest concern, but rather to that predetermined set of things that they are geared to. I'd go one step further with this argument. The CFPB has a complaint portal. That complaint portal lists very, very few payday loan complaints. But when you analyze where the payday loan complaints come from, they come from many states that do not theoretically have payday lending. How can that be? It can be because people go offshore to get these loans. And it seems to me that one of the easiest and best things that CFPB could do would be to strike at that. And they would certainly have our full cooperation with that. The second procedural question that I have objection to is the manner in which they have done research. So far, they rely largely on two things. A white paper, which they did in May 2013, which they admitted 1 month after initiating had not used the proper base on which to calculate their results, and work from the Pew Charitable Trust. The work from the Pew Charitable Trust is interesting because it is a great exercise in deception. You and I are acquainted with Pew Charitable Trust and its research arm, but there is such a thing in addition as the advocacy groups. The advocacy groups are not the research arm. The Pew research, in quotation marks, is all done by the advocacy groups. Let me draw the contrast for you. The white paper that was done by Pew Research, that has become a mainstay of research for the CFPB, interviewed 457 people to get the poll on what they thought about payday lending. The real Pew Research, in doing a recent study on religious habits in America, interviewed 133,000 people. There is no comparison between what Pew Research as a research organization is and the Pew advocacy groups, which not only do some research sublet out to individuals, but also are lobbyists on behalf of a certain outcome. They have hired lobbyists largely across the country and in the Capitol to do that. My third objection to their process is the inequitable way they have treated those who would wish to make an argument on behalf generally of payday and those who wish to be its critics. The critics have received what I would call extra special care. We fight for the ability to go in and make our points. I will be happy to send you the material that we got back under the Freedom of Information Act that suggests a cozy relationship improper for a regulatory agency with CRL, with Pew, and others. It is not a hardening thing to read a FOIA which says, in effect, I miss you. I need a fix from you. I would like you to come in so I can get straightened up on a few matters. I feel inadequate without your view. I wish we had received any one of those kind of comments from CFPB. And I also wish that CFPB, on the occasion of its Richmond hearing, which was the first real prelude to the rule, hadn't held a victory party, which was in honor of the fact that payday from then on would be dead. This is not an agency that is conducting itself with anything like the rigorous detachment and willingness to accept evidence from all sides that is necessary if you're to get to the bottom of a tricky question. And may I say, I have, I think, a particular perspective on this. I came to this job from the Financial Services Committee of the House, where I worked for my third stint for Chairman Barney Frank. I had worked on many, many issues which are complex that are involved in Dodd-Frank and prior to that in international affairs. And when I thought about taking this job, I thought to myself, how difficult can it be to take up payday lending and other consumer loans as opposed to derivatives, stock swaps, and everything else that was at the heart of the banking issue in 2008. To my surprise, this area is much more difficult than it appears at first time. Who should get a loan? Under what circumstances? For how long? And if you go through the literature, which I have and which I commend to you, you will realize that there are many, many conflicts within the literature. There are 3 Federal Reserve Bank reports within the last 5 years which arrive at the conclusion that payday probably on balance does a little good and doesn't do any harm. There is a body of literature which believes it is very harmful. Isn't part of what the CFPB should be doing to ask those questions, farm out the research, and get to a conclusion? On the contrary, what we have seen that is, as it took on the auto industry, for example, and in getting at dealer incentives and dealer loans, it took the word of an advocacy group rather than doing its own research or rather than farming it out to a reputable source. I fear this is the case here as well. Now, on substance, I find many things that are worth considering here. First of all, they hang their heads and say their rule is framed in terms of an ability to repay. But the ability to repay they have is actually many things. It is like a Christmas tree, studded with questions involving database, questions involving waiting and cooling off periods, questions involving an analysis of whether or not, if a second loan is to be made, the actual economic future of the a proposed borrower has improved. All of these things are not, strictly speaking, related to ability to repay. There is no one I know of who does not believe that ability to repay is the keystone to making any loan. If you don't have an ability to repay and you're in the business, how do you determine whether you can make a profit? So I believe that it has been a rationale for a much greater delving into the details here. Pressed on this question, the CFPB told us in a recent meeting that the rule they will issue will be somewhere between 700 and 1,000 pages. Is that intelligible to the customer who will come through? Is it useful for the operators? Is it something that will be beneficial to the general public? Their fundamental test of using the residual income standard begs this question. Aren't most people who come to a payday lender devoid of residual income. That's a very different statement, saying you want residual income, than saying, I want to make sure you can pay all your other bills besides repaying this particular loan that you're now taking out. In general, my belief is that the CFPB is a well-intentioned group of people who have very, very little acquaintance with either our customers, virtually none with our operators, and who have a fundamental misunderstanding of payday. If you go through this recommendation of theirs for the rule that is to come, you will notice that, again, though they are directed by the Congress to take up the issue of payday lending, they have not done so with any definition to this point of what payday lending is. We run into people in the CFPB who believe that refrigerator sales or auto sales might conceivably fall under payday lending because in their hearts they believe that anything that is above a 36% rate is a payday loan. That's not the case. So I am...
If you could wrap up, Mr. Shull.
Yes, I will. Thank you. I would like to say this. This is a complicated issue, but I do believe that it is possible and ought to be our objective to get to this result. A payday product that recedes into the background as more products are available to customers who come into a payday store. Secondly, that the payday product and any other product must be limited in its duration and limited in the amount of money that a customer pays out in so-called interest charges. We ought all to be able to agree with that. And third, we ought to be able to work out together exactly what that means in terms of times that people can take out a loan, sequences, etc. With goodwill, that can be accomplished, I truly believe. Thank you.
Mr. Leonard, in an effort of fairness, we'll give you an extra 2 minutes as well.
Thank you very much. My name is Paul Leonard. I'm the California Director of the Center for Responsible Lending. We're a nonprofit, nonpartisan research and policy organization dedicated to protecting homeownership and family wealth by working to eliminate abusive financial practices. I should say that CRL is an affiliate of Self-Help, one of the nation's largest community development financial institutions. We operate credit unions here in California and North Carolina and Illinois. Over 30 years, Self-Help has provided more than $6 billion in financing to help nearly 90,000 low-wealth borrowers buy homes, start and build businesses, and strengthen community resources. We operate, as I said, we operate credit union branches here. We have about 20 credit union branches in California, serving 70,000 members and clients in the Bay Area, the Central Valley, and the San Gabriel Valley in LA currently. First of all, I wanted to just give a little bit of data about payday lending here in California. We've already heard a little bit, especially from the commissioner, but I think it's really important because I think the data itself serves to make the point that the payday lending business model relies on repeat borrowing. Fundamentally, it's advertised as a short-term fix for an emergency financial problem, but fundamentally it relies on repeat borrowing as the way it stays and finances its business. Here in California, as the commissioner noted, the largest single category of borrowers in 2013 were those who took out 10 or more loans. Those borrowers, however, accounted for 60% of all of the loans that were made here in California. 76% of all borrowers were taking out 7 or more payday loans. It is the typical experience for borrowers here in California. Those who are taking out 1 loan a year or 2 loans a year or 3 loans a year account for less than 5% of all of the loans and all of the borrowers who are taking out all of the loans that are being taken out, not all of the borrowers, I should say. So fundamentally, that is our view about the nature of the payday loan product. And I think it's important to keep that in mind as we think about what the CFPB should do. We earlier testified in May of this year before the Senate Banking Committee, and I provided a copy of the extensive testimony that we provided to each of you today. In short, I wanted to sort of give you an accounting of what we think the CFPB should be doing. First of all, we look forward to seeing the final proposal. We don't know what the final proposal is going to look like. It's coming forward sometime at the end of the first quarter. We do think it should cover explicitly short-term and longer-term loans, including explicitly car title loans. One of the great values of the CFPB laying out federal rules on this is that its rules and its enforcement ability will cover not just the licensed lenders that here in California and in other states, but all lenders, whether they're operating from bases here in the U.S., offshore, tribal lenders, will have a standard federal floor of regulations covering all such loans. We fundamentally support the CFPB's approach to use ability to repay as a cornerstone, including requiring evaluation of the borrower's income and the borrower's expenses, including both debt obligations and housing expenses. We think that it's critically important that reporting requirements facilitate back-end monitoring so that we know how these loans perform, whether or not there are excessive levels of defaults that are occurring.
What would that look like?
What would the back-end enforcement look like? Well, I think one of the visions of the CFPB is that there will be a mechanism, much like we have credit reporting bureaus, that all of the lenders will report to. And so there will be standardized sources of data that will allow us to know what individual lenders are doing, much like the commissioner of the Department of Business Oversight has access to that lending data. One other point on that data, I should say, in regard to the commissioner's desire of having reasoned arguments based on data. Number one, we certainly try to bring reasoned and thoughtful data using the data that is available to us. We have done probably more with the data from the Department of Business Oversight here in California than any other entity that I'm aware of. I would also say that there's some severe limitations, most notably that the data that's available on payday loans is only available in an aggregate basis, so that we don't know what the performance is of any individual lender or licensee. And that is a significant drawback to understanding what the nature of those markets look like. We agree that there need to be strong payment protections. With regard to the structure of the CFPB rules itself, there are both there's rules for short-term loans, rules for longer-term loans. In each case, both the short-term and the long-term, there is one sort of a general rule that applies, and then there's an alternative that is provided as an alternative to the general rule. In both cases, we believe that there doesn't need to be an alternative, and the core of the general rule is around ability to repay. Our fundamental belief is that all loans should have a required ability to repay that is performed by the lenders to determine whether there's a reasonable likelihood that the borrower will be able to repay the loan under the original terms of the loan without having to reborrow to meet their other expenses, which is the core of the debt trap problem that we see in the payday lending arena. 6 unaffordable loans, which is what the current CFPB proposal allows under the alternative, without any underwriting whatsoever, we believe continues to have the ability to cause great harm to consumers. High-cost, unaffordable loans that will leave borrowers worse off rather than better off in attempting to meet a financial emergency. As I said, as a general rule, we believe there must be a robust underwriting requirements for ability to repay on every loan. We also believe that there should be a 90-day backstop that's applicable to all short-term loans, even those that are underwritten under the general rule of the proposal. This is for 3 reasons. 1, underwriting for ability to repay is predictive but not determinative. Some borrowers could run into trouble, and we don't want borrowers to fall into a debt trap. So a 90-day over the course of the year would be a backstop for that. Second, any repayment that has a coercive repayment device, such as access to the borrower's checking account to get repaid, is not really evidence of the ability of the borrower to repay that. Let me say clearly, if the payday lender can attempt to cash the borrower's check or electronically reach into the borrower's account to get paid, that is not validating the notion of ability to repay.
About 1 minute to wrap up, Paul.
Thank you. Long-term loans, we think the long-term loans, because of their larger loan term and larger size, can be even more dangerous than the short-term loans. A key issue is not only ability to repay the monthly payments, it's also the ability to ultimately pay off the loan and get out of the loan altogether, so that those two don't create long-term debt traps. We think that the CFPB rule as proposed provides some predictable abuses that will keep people locked in a cycle of debt and unable in practice to repay their loans. Small payments plus slow amortizing lead to enormous payments that make little progress in actually repaying the principal of the loan. Loan flipping or repeated refinancing often mask the inability to pay the increasing costs of the loan and keep that person trapped in debt. So for those longer-term loans, we think there needs to be stricter underwriting for longer-term loans, especially those that have slow amortization, long terms or slow amortization schedules. They should be prohibited from using refinances or loan flipping to mask or inhibit the ability to repay. Indicators could include refinancing before the consumers have made significant progress in repaying the principal, such as the established as a precedent under our small dollar pilot program.
30 seconds, Paul.
Two more quick things about the CFPB rules. Number one, we think car title loans are included, and we think they should be included. The fact that borrowers are at risk of losing their car on a high-cost loan suggests the great potential harm. So any loan secured by a car should be, in fact, covered. And finally, we think the CFPB needs to look really hard at this issue between sort of switching back and forth between short-term loans and the longer-term high-cost installment loans, and using one or the other to allow borrowers to get trapped in cycles of debt is not an appropriate solution. Thank you very much.